Tesla clearly has the potential to be worth $40 trillion, with its stock reaching explosive levels. What are Tesla's $40 trillion chances? It comes from Morgan Stanley's parent of all capex cycles research paper. What is the main theme of this research report, and will the next 12 months show investors how important Tesla and the rest of the auto sector are in the transition away from fossil fuels? Keep watching to find out. Electric vehicles can play a major role in restructuring the renewable energy transportation economy. Assuming that the entire auto industry transitions to electric vehicles, many believe that the entire world is about to run on batteries, leading to the next invention of the battery and the materials that go into it. The best way to capitalize on the profitable momentum of multi-trillion-dollar energy transitions. According to Bloomberg, the new energy fund's investments in the global energy transition reached a record $501.3 billion in 2020, and huge amounts of money are pouring into new energy in a way befitting a revolution. Foundations, and endowments with assets exceeding $14 trillion are preparing to support the energy transition. Forbes refers to this as a paradigm shift. That's a lot of money, and one of the concerns investors have with legacy automakers is that they have a large industry based on internal combustion engine vehicles. Legacy automakers are trying to serve two things with this massive commitment to internal combustion engines and electric vehicles. They can only serve one customer, and if it's not for EVs, they'll go bankrupt. Clean energy is also becoming significantly less expensive. Electric cars will soon become as cheap as conventional cars, perhaps as early as 2026 or earlier. Energy storage costs are also falling at a rapid rate. The key to all of this is storage. All of this is impossible without advanced batteries, which necessitate the use of battery metal. Tesla currently occupies the leadership in this industry in terms of electric cars and renewable energy in general. Harnessing this transformation will further enhance the brand and potentially double or triple its value. Tesla is both overvalued and undervalued, according to Morgan Stanley. They believe Tesla is expensive as a pure car company, but highly undervalued as an onshore renewable energy infrastructure company, and Tesla is seen as the ultimate investment in battery capex, according to them. According to Morgan Stanley, energy innovation will be rewarded as a result of two major events: war and inflation. Under current circumstances, we believe developments in the next 6 months will have a significant impact on the narrative surrounding what Tesla does, the markets it serves, its growth profile, and the global strategic implications of the ecosystem in which it sits. Many investors are also beginning to see the benefits of Tesla's direct-to-consumer model, something legacy automakers can't do because of strong restrictions on government dealer franchises. Instead, it cuts out the middleman and reduces political play, thus allowing the brand to properly serve its customers. Essentially, Tesla may sell cars anytime and however they want. Legacy. Automakers use antiquated dealerships with outdated sales practices, plus additional partnerships and reeking bureaucracy. Morgan Stanley believes the battery's multi-decade capex cycle is driven by bigger reasons. As globalization advances into a new era characterized by heightened national security concerns, investors must consider new energy supplies and new infrastructure. Battery storage will be crucial in the future, and Tesla is well positioned to lead the way. Tesla will be able to produce more batteries than anyone else, with Elon Musk claiming that Tesla will likely start its own mining operations by either acquiring mining companies or starting its own business from scratch. It is encouraging that Morgan Stanley is considering Tesla options outside of the auto industry, their price and earnings per share targets. On the other hand, the forecast is confusing and much lower than many investors realize. When Tesla's market cap exceeded $1 trillion last year, many naysayers were shocked, to say the least. This was a feat previously achieved only by Apple, Microsoft, Amazon, and Alphabet, thanks to a $4 billion deal to sell 100,000 cars to Hertz, a car rental company. However, it's important to note how different Elon Musk's company is from the rest of the pack. First, it is classified as a garbage bond. As a result, Tesla's long-term debt was recently upgraded to B+, one notch below investment grade. Its sales and profits are much lower than those of competitors. Tesla is expected to generate $6 billion in revenue this year, one-fifth of Amazon's revenue, and about a 20th of Apple's revenue. The dispute over Tesla's value continues. Tesla is worth more than almost all other major automakers combined. Analysts are divided on the current situation. Tesla's $1 trillion mark is just the beginning, Daniel Ives of Wedbush Securities said in a recent tweet. In the bear camp, Craig Irwin of Roth Capital Partners expressed in a note to a client that Tesla stock was outrageously expensive at 173 times next year's earnings as a result of several countries cutting electric vehicle subsidies and the current macroeconomic situation, and analysts expect that the market is consolidating with the poor. Trademarks. It is certain to be eliminated, according to analysts. So how is Tesla currently performing? Tesla investors have had a roller coaster year. The stock started the year at around $1,200 per share. Automotive company stock price. Then it dropped to values well below $800. Shares of an electric vehicle manufacturer. It is currently trading at only around $1,000. Much of this volatility reflects the company's enormous uncertainty about its future, especially in the short term. The company's production rates are taking a hit as a result of the cessation of manufacturing in Shanghai due to the COVID-19 restrictions imposed by the government, and no one knows the extent of this. Fortunately, according to Reuters, the company plans to begin operations at its factory in China soon. However, given the requirements for third-party supplier participation, it would be strange to see a slow ramp-up back to previous production levels when Tesla reports first quarter results on the 20th. Investors are hoping to get some answers. How quickly does the automaker expect its Shanghai factory to resume production after the shutdown? Is it possible for Tesla to achieve its year-round vehicle delivery goals as a result? When will Tesla announce its earnings this week? Any forecasts the company makes for full-year vehicle deliveries will be the most important item for investors to monitor, while a 3-week halt in Tesla production in Shanghai increases the chances that the company will need to lower its full-year vehicle delivery forecast. There is still a chance that its initial forecasts will be fulfilled. The company's new factories in Germany and Texas are at the heart of this issue. Management stated in the automaker's fourth quarter update that it would likely achieve more than 50% growth without the contribution of these new factories, but since that time, both factories have come online and both have the potential to become big drivers of production volume for Tesla. To new manufacturers. Tesla is entering a new chapter of expansion. Elon Musk chose to kick things off by hosting the Cyber Rodeo in Giga, Texas, which will eventually become the company's headquarters. As Tesla often does, the Cyber Rodeo generated a free ad with an estimated 15,000 invitations distributed and a larger number of viewers trying to attend without an invitation. The event attracted large crowds. USK also included an update to its business plan. In his presentation, he predicted that 2022 will be a year of expansion, and that 2023 will bring a slew of new products, including the Semi, Roadster, and Cybertruck. Tesla also stated that this new facility is an engineering feat because it is the largest factory in the world by volume as a result. Tesla's ability to integrate all parts and operations under one roof, rather than separate buildings like previous manufacturers, is even more surprising. We believe Tesla's cost leadership in battery powertrain technology is a critical competitive advantage that has allowed the company to produce price performance and competitive combustion electric vehicle models significantly ahead of its competitors. What does Tesla stock hold for the future? Tesla's stock price in the future will likely be determined by the rate of transition to electric cars from traditional fossil fuel engines, in addition to the company's financial performance. As mentioned earlier, with Tesla at the forefront, this $40 trillion opportunity is ready to be seized. We believe Tesla will be well positioned to benefit from the long-term transition to electric vehicles, given its leadership position in electric vehicles. Tesla's financials should benefit from an increase in the Model Y, as well as new factories in Berlin, Germany, and Austin, Texas. In the long term, an increase in the proportion of electric cars. What are some of Tesla's expectations for the second fiscal quarter? Comment below.